Good morning, ladies and gentlemen. Well, after a very bullish week, I think we have to look at the background of what the spreads are saying and take a bird's eye view of the situation, because it's not going to be anywhere near as easy as most people seem to think from now on. In fact, I think it gets a hell of a lot harder. So we have to understand why we are at minus 88 and why we are likely to stay at minus 88 for quite some time. It's going to take a long time for the spreads to say anything different from what they're saying at the moment, and that is that we are in a risk-off period, a profound risk-off period, which is going to take weeks, if not months, to resolve. We are still in risk off in TLT, and it's going to be very much harder from now on. The rallies are going to be a lot shallower, the dips are going to be a lot deeper. It is going to be very hard indeed, and I think the best thing to do is to have a look at an overall bird's eye view, and as a result have a much better idea of what we're in for the next several weeks. The first component of the spreads that I think it's important to look at from a bird's eye view, and this is a monthly chart, so each of these bars is 1 month worth of price action, is the yield curve, the 2s, 10s. You can see that what I think here is that we've done a bottoming action, and that we are basically now trading between 30 to 35 basis points and 75 basis points. And we are probably going to do a kind of several months in this area. And when I say several months, we probably stay here until the end of the year, before at some stage going back towards the 125 basis points and possibly all the way up to 270 basis points again in several years' time. What does that tell you? That tells you not a lot for the next couple of weeks, but it tells you that while the market stays above the 30 to 35 area, we are unlikely to get any more panics. To me, that is good enough to tell me that the market is in a consolidation phase, a phase which is going to last months, certainly many weeks, and possibly the rest of the year. If we now go down to a daily view, so each bar is a day, you will see why that is important. We have made a low pattern here between the 35 and the 12 or 13 basis points. Every time the market is feeling very risk off, we go down towards the 12 area, and every time we are in risk on, we go above the 35 area and we go towards the 75 area. I don't think that is going to change for a very long period of time. At some stage we might get dips down towards this 29-30 basis points area, and that is really a very good place to have very long-term positions in 2s, 10s, because I think the path of least resistance at some stage is going to be reflation and a very steep yield curve, which takes us much higher than this 75 basis points that we got out at a couple of weeks ago. It was a good area to get out at, but I think when we get down to this 30 area, it is a very, very nice area to be exceedingly long of 2s, 10s. This to me is what it's all about. It's between the allocation to equities and long-term bonds, SPY over TLT, and this is a weekly chart. So where do I think this market, if you look at it, it was picture perfect, the low. right at the 0.618 retracement of the whole move between 2009 and 2019. This was your warning. It wasn't making new highs with the market, with S&Ps, and it just collapsed. Now, as I told you a couple of weeks ago, I think it trades between this 140 level and this 180 level. When we get to 180, and we're not very far away, I think risk off is going to predominate again for a move back down to at least the 160 area. So we're going to do a mirror of this price action between 14 and 16 when not a lot happened in the market. Okay, if you ask people what they are expecting for the next, I don't know, year or whatever, you will find some people who are extremely bullish and you will find some people who are extremely bearish. But you'll find almost no one who will tell you that the market is going to be stuck in a 10% range or something like that. Certainly not what volatility is telling you at the moment, but that is the way of the markets. They have discounted, as I told you last week, this move to me was pretty obvious. The market was going to carry out all the bears, it was going to discount much better news, and now it can sell into those much better news when we get them. The reopening, the famous reopening of the economy. Well, I don't think it's going to be as easy as that. You do not buy on the reopening of the economy. The market's already discounted it. So I think that when we get to this 180 area, that is where I'm looking to actually go short of risk rather than long of risk. This is as I said, a weekly chart, and it tells you why the risk dial is going to be negative for a long time, because these moving averages are only now turning and indicating lower prices. This is that same chart we've just seen, but on a daily basis. And now you can understand why the picture is going to be very, very difficult to read for a long time, because you can see how even during the bull market that we had between 3,000 and 3,400, this was not making new highs and was giving the big divergence and telling you that something wasn't quite right. And then we had an absolute dump in the, in very few days. This line to me is going to be key. We haven't been able to get above it for a couple of months, and the moving averages have basically keeled over, and they are very rapidly going to catch up with the price action. If we get to this 180, 183 area, that will be your signal, I think, to get short of the market, because the reaction from these levels is likely to be to the downside. So you have your answer as to why the spreads, which never lie, the spreads never lie. It is impossible to have a bull market in equities which is sustainable and lasting without these moving averages being pointing upwards. I've never seen a bull market with these moving averages pointing downwards. So the idea that we're going to go back to a V-shaped 3,400 plus area is absolute rubbish. We need to do a lot of action here before we can, before these moving averages have caught up and turned. A lot of price action. This is weekly SPY over IEF, so the 7 to 10 year area. And it's a slightly different chart, but it tells you the same story, i.e. if the market gets to 250, it's a very, very big short initially for a move back down to where we are, or even lower around this 220 area. If we turn this to a daily, and I'll do that in a moment, and it takes several minutes to do it, that's why I'm going to cut it out, you will see that the picture is just as bearish really as the picture in the TLT, and I'll do that for you now. And here is the daily picture. you can see that this 250 area is going to be exceedingly difficult to break. We can certainly get towards it, which would imply another squeeze in the SPY. But when we get there, it's going to be risk-off time. There's absolutely no question in my mind that we will revisit these areas between 220 and 230 as soon as we get anywhere near to 250. The reaction is going to be bang, back down. That to me tells me that yes, we do have some more upside in SPY, probably to 2864, and you know the famous 2864, and I will show it to you later. But at some stage you do have some very strong reactions off it, and probably in the order of 10% in equities, and we will look at that later. This is a weekly XLY over XLP, basically telling you how the disposable income of the consumer is doing, and this actually topped out in 2018 and has been rolling over ever since. Well, we got to levels, I mean, this is why spreads are so amazing. It caught the precise level that it had to catch, the 166, and it's rallied off it, but it's going to run into big trouble here around the 191, 192, implying another 2, 3, 4, 5% maybe in the S&Ps to the upside before a big reaction lower again, I would have thought. And I will now show it to you on a daily basis so you can understand why it is even more bearish than that. This is the same XLY, XLP, but on a daily basis. It is rolling over, and you know, a little bit more up to this 190 area, and we are pretty much done. This would imply that the upside in the market is not huge. XLY is a huge sector within the S&Ps. If the consumer is tapped out, the market just cannot rally that much. To me, this is saying it's going to take a long time to repair this XLY, XLP relationship, and the reactions lower are going to carry the overall market lower. It is very unlikely that we just go up towards 195 and 2 and stay there without deep reactions lower. Another chart that is very important with the Fed doing what it is and buying up all the credit markets, it is the INX, i.e. the S&P against the IWM, i.e. the Russell. So smaller caps against bigger caps, as it were. The Fed turned the market, absolutely turned the market, because as the spreads come in, as the credit spreads come in, equities of smaller companies can rally and rally more than the big companies. The Fed will continue to turn this market and probably test this 21 area. I think there it's going to be very difficult for the market to, for the Russell to outperform the S&Ps. Well, what does this tell me? This tells me that the upside in the S&Ps is a lot less than the upside in Russell. Say that this spread is going to come in another 500 basis points, another 5%. Well, that probably tells me that the upside in the S&Ps is another 3%, and the upside in Russell is another 8%. So that is, it's all basically telling you the same thing, that the upside in S&Ps is single digits positive, while certain other markets have got a little bit more. But it's much of a muchness, and now we can go and see what happens if we just extrapolate those few percentage points up in the S&Ps and what kind of resistance it comes up against in its own chart and against the volatility chart. here we have the daily S&P with a very important 2864 level marked and 2950, which is basically the reaction from it. This is what has to be the most likely scenario, and it is that we have a reaction to the 100% of the A move here, A, B, C, 2900. So 2864 is going to be trading again with 2948, the absolute outlier. I just can't see the market higher than 2948 on any kind of sustained basis, and basically then we have reactions lower from that area. I certainly think that in this area it is a put buying area for reaction to 2700 and 2600 over the course of the next several weeks. All the spreads, when I look at them on a longer term basis, tell me that no way is this market out of the woods in terms of a V-shaped recovery and we never look back, i.e. are we going to go to 3100, 3200? Quite possibly in 6 months time or whatever, but we need to do a lot of work here with sharp reactions lower before we are ready for any kind of sustained move to the upside. From a volatility standpoint, that actually matches very well. My contention has been that we would mirror this kind of formation. This is a very, very difficult time in the markets, and this is 2008, 2009, when we had a similarly difficult time in the markets for completely different reasons. I'm not even going to compare. To me, the idea of comparing 2008, 2009 with a natural phenomenon and a government-mandated shutdown is for the birds. You really have to be an idiot to believe that. So, to me, I'm looking at this now 37% area for a kind of bottom and a reaction higher, which matches with this idea that we will trade 2864 to 2950 before we have very sharp moves back down into the 2600 area. And that will be the opportunity to pick up some cheap equities. It all matches with the XLP, XLY, longer term, shorter term. It all matches with the TLT and the SPY, the IEF and the SPY. So to me, therefore, what the spreads are telling me is that it's going to take a long time to repair the damage done. And if that takes a long time, it makes sense that the market does what it actually no one expects it to do, and that it churns in a 10% range and makes monkeys out of everyone, the bulls and the bears, for a protracted period of time. Certainly, I would say a quarter, if not two, before we are ready to make another major move in the asset spreads, which I would say will be signaled by something like TLT SPY, and will be actually anticipated by the 2-year to 10-year curve. If the 2-year to 10-year curve starts steepening a lot, i.e. above that 75 basis point area that I showed you earlier, that will be the signal that we are in major risk on. Thank you very much indeed, and tweet you on Monday.